Kanika, hi, good to have you with us. How have you been?
Hi, very happy to be here. I've been good, semi-quarantining as usual for wave number infinity.
I know.
How are things at your end?
Things are wonderful, Kanika. It's good to have you with us. And,
Yeah,
such is
happy to
life,
be here.
right?
Yeah,
I think with Corona, I think this has become the constant, right? This is the new normal that we'll have to possibly
correct.
continue to live with, right? But I think
It's
it's been,
also
it's
a
been,
new small talk, right? As soon as you start any Zoom call, you're like, "Hey, is everyone okay? Oh,
that's important.
cases, etc., etc."
I think we've become a very concerned society, right? I think which was possibly missing, right? So
Correct.
I think possibly that's a good takeaway, right? While it's been a difficult time for I think each one of us at a personal level,
Yeah,
but
yeah,
it's been good, right? We've been concerned,
yeah,
and I think that's
yeah,
important.
yeah.
Kanika, this is
Good.
an important conversation, right? This is an important conversation, right? I've been having a lot of conversations with many founders in the wealth tech space, right? In the money management space, right?
Yeah,
And it's absolutely brilliant to see many platforms come up, permutation combination come up, right? And how effectively everybody is building solutions to manage money better, right? All of a sudden this seems to be a key priority. For
yeah,
some reason this was not necessarily an area of concern, but I think also what COVID has really done is that it's made people to sit back and think about their value creation, wealth creation,
yeah,
value preservation, for example, a
yeah.
lot more seriously, right? We've seen a lot more capital get into the secondary market, something that we did not anticipate, right? We continue to be an economy which struggled with 3% of savings, 3.5% of savings, right, for the longest time as part of equities, right? That has kind of
Correct.
changed. We're seeing more
Yeah.
money coming into riskier assets, right? So it's been an interesting time, right? That's become an interesting conversation. And when I read about Upside AI, I think one of the things that stands out is and a fairly bold comment, right? That stayed with me was AI is the new Warren Buffett, right? Now, how cool is that? Hadn't heard for that for the first, that before, and this is like a line that stands out, right? And through the course of conversation, we're going to continue to emphasize on many things that you're doing. How are you improving the landscape? How are you kind of understanding your customer? Because risk, for example, has changed, right? The dynamics around risk have changed, right? So we're going to cover
Yes.
all of that through the course of conversation. But
Yes.
like I said, it's good to have you with us,
Yeah. Excited to
we
talk to you.
and we're going to start with a quick round of introduction, right, Kanika? If you're
Great.
going to talk a little about yourself, and then we dive into the questions for the day.
Perfect, perfect. So thanks, Ashu, for having me and Upside on. I'm co-founder of Upside AI. Me personally, I have finance and investing has been my whole career. I
Sure.
started my career at EY, spent some time at Credit Suisse, investment banking, and then I went
Right.
to work with Mayfield, which is a venture capital fund.
Right.
So doing early stage investing, SaaS, consumer internet, etc., for about 4 years before moving to the public side. Educationally, I'm a CA and CFA by training. So literally been doing finance the entire time. I have two co-founders, both from IT Bombay, Atanu and Nikhil. Nikhil is IT Bombay, BTech in computer science,
Right.
has a PhD in machine learning from there. And, and Atanu again, IT Bombay was in New York for many years with a large investment group. And then we started this together.
Super, super. What a great start, Kanika, right? And I think somebody coming from a venture capital space, investment banking space, and kind of doing money management, right? They're
Yeah.
they're very different, right? For the common audience, they don't necessarily understand. For them, investment banking
So,
essentially, for a large part of people, right?
yeah.
They think investment banking is money management, right? Which is a
Yeah, correct.
which is a wrong
Acha,
point of
banking.
view.
Acha, bank job. Now, what is that, right? It's just a catch-all. My mother still is not entirely sure what I do. So,
Interesting, I can imagine. Kanika, when I look at Upside, right? I think what you sort of communicating to the world, right? That investing made simple, smart, and systematic, right? I think that's essentially what you're kind of talking about, right?
absolutely.
What's the foundation? What's the framework of Upside? I'd love to understand what's the construct of Upside.
Sure.
What is it that you're solving uniquely, right? Is
Sure.
what I want to start this conversation.
Sure. So let's start at the beginning, right? One is what are we doing? We're essentially trying to teach machines fundamental investing, right? Can you figure out how to read P&L, balance sheet, cash flow data, figure out how to read macro signals, etc., and make smart investing decisions? We are not algo traders. I don't trade every day. I don't look at a Bloomberg screen. None of that. You
Right.
buy, hold, forget about it. The only difference is, machines help us make those decisions and not humans.
Sure.
And so why are we doing this, right? Who needs this? Why did we start on this journey? So there are two sort of answers to that. One is what's happening on the product evolution side across the world, and two is how we think humans invest.
Sure.
Right. So any data you look at, any country, any investment product what you will see is that over long periods of time, humans are average investors.
Sure.
They'll have these periods of outperformance where the way they think, the market thinks, aligns, and they do really well. And then over time, they revert to mean. S&P did a study recently on mutual fund managers, right? 80% of mutual fund managers in India underperform their benchmark for 5 rolling years.
Right.
Same thing is true in the US. And that's why what's happening in the US is a very clear shift away from humans into rules-based investing.
Interesting.
Right? And this is true across ticket sizes. So retail money there is moving from active mutual funds which are run by people into ETFs. ETFs are rules-based products, right? That's just saying I'm going to buy an index. At top end of the pyramid on hedge funds, top 5 hedge funds in the world are all quants now. Right? So that seems to be a very clear theme on less humans, more rules in terms of product evolution. And India lags a little bit on product, 5-10 years behind ya jo bhi. That's the broad direction in which we see the world headed, which is humans will have lesser and lesser to do with actual money management and maybe more relationships, wealth management. I can still see a use case for humans, but much lesser in the actual investment decision-making process.
Interesting. Kanika, sorry, please go ahead.
No, so that's really the sort of reason why we ended up starting.
Interesting. That's a very, very, very important point that you made, right? And I want to actually sort of, I want to spend a little time understanding this particular point. Now, when you talk of, say, for example, humans investing and them, for example, say being inefficient, right? Or there being a lag, right, of some sort. And that's largely because, there's a processing time, so on and so forth, right? Now, when you talk of machines, right, and you're possibly, what you're kind of indicating is that you're not necessarily an algo trading driven system, right? Which is very mechanical, which has its peaks and bottoms defined, right? And if there's a swing in that zone, you essentially continue to stay put, otherwise you transact out, right? Which is very, very fundamental way of looking at it, right?
It's in many ways solved. Everyone who's doing technicals is using some software to do it, right? Now, or HFT or whatever.
What you're alluding to is a very, very different way of looking at it, right? Where you're saying that, listen, I am tracking the fundamental, I'm tracking fundamentals of business, right? Where possibly you're taking in balance sheet or publicly available data, and you're possibly taking news, right? Now, typically in a traditional, stockbroking setup, essentially how it happens is if there is a news which is broken out, right, and organizations have a responsibility to break it to the exchange, analysts typically factor in that information, right? There are certain models that are established. The information goes in there with certain outcome possibilities, right? And that's the foundation of stock price movement, right? Now, when we talk of stock markets, right? Now there is, again, like there's a lot of quantitative information, there is a lot of qualitative information, right? The data is very inconsistent, right? What that means is, irrespective of whether you try and teach machines, the best possible models, right? There will still be inconsistency, right?
True.
Coming back to the point that you highlighted, right? That index funds are possibly the best bet, right? And human managers are not doing as good a job, right? The market kind of discovers the price in the process, right? Don't you think that's again a problem that you're going to face with machines? Because like I said, data is inconsistent, right? There's like a lot of qualitative information available, which is not necessarily how you can factor it into a quant form, right? That essentially makes you operate in the same zone, right? You still could have those problems that.
For sure, 100%. So when we say we use machines, does that mean that it's not God? It picks bad stocks, right? It makes poor decisions. So in general, when we're buying, we have a portfolio approach where we buy about 15, 20 stocks at any given point of time, right? And like with all other portfolios, 40% of it does really well, 30% of it does similar to market, and 30% of it does poorly, right? So that does happen. It does, and they're not mistakes, right? What have we told the algo to do? Where we told the algo to do, hey, listen, given the market conditions today, given everything you know about fundamentals, can you find the best portfolio that I should buy today? That's what it's asking you to do. Now,
very interesting.
So that's what it's buying. Now, what it'll do, like you said, markets change so rapidly. There are themes that play out, themes that don't play out, and therefore it's not always that it's going to do well. So, and with humans, the problem is not that they don't have enough information. Everyone's looking at the same, hopefully looking at the same publicly available data. It's not even speed. I'm not trying to capture news movements. I'm not trying to capture the arbitrage between when the news results, the financial results came out and when they didn't. All I'm saying is I'm unbiased, I'm unemotional, and I'm all types of investors. I can be a chemical investor, I can be a steel investor, I can be a cement investor because I use a machine, right? What we're saying is different with humans is 2-3 things. One is there is fear and greed, panic, all of those emotions, biases, a bunch of things happen which clutter their decision-making process, and that's why they make suboptimal decisions. It's not lack of information. It's the emotional, the whole behavioral finance part of it, which is why they're poor investors. So for example, and similarly, right? So for us, when we were buying during COVID, March 2020, middle of the free fall, don't know where the bottom is. We're not sitting in cash. We're actually buying specialty chemicals because that's what the algo asked us to buy. And that did very well for us. Right? But cut to 9 months later in December, we've moved into metals and mining. Right now, we're looking for high leverage stocks, but cheap value stocks. It's a very different theme. So when you buy an ex-manager, you're buying his approach.
Correct.
Whatever it is, he's an expert in something.
Right.
What we're saying is we're an expert in nothing and everything. Because we don't care, right? The machine doesn't care that something is a sugar stock or not, and it has no biases to say that, hey, listen, I lost money on sugar last quarter, so this quarter I won't look at it at all. Once a human burns his hands in a certain sector, very hard for him to go back and look at it objectively. So those are the kind of things.
Very interesting points that you're making, right? I would love to understand the process, right? Are you, for example, we started this conversation where you said that, listen, we're doing fundamental stuff, right? But are you also sort of blending, technical information? Because technical information also gives you, the momentum of the market, the speed of, with which the market is acting and reacting to a certain news, right? And thus technical becomes important, right?
Yes.
It's a tool which is now very avidly adopted, right? People are getting enthusiastic about it, people learning about it, right? Are you doing that? Are you not doing that at all?
Complicated answer, but we're using we're not really doing technicals at all when the algo's parameters do not include volume information, do not include price movement, none of that kind of typical technical stuff. But am I trying to understand the direction of the market? Absolutely. So when I'm trying to pick a bunch of stocks, right, it's like I'm trying to solve a demand supply problem. The supply of companies that comes in, I'm trying to figure out what's a good stock, what's a good company fundamentally. And then there's a demand for these stocks. So I'm trying to figure out what does the market think is a good company. And buy things at the intersection. It's like saying Maruti is a good company, you can buy and hold, forget about it for 10 years, no problem. Right? Presumably, let's use that in the example. But the market thinks Maruti is a good company and it cycles. Right? So can you figure out when you should be buying Maruti and when you shouldn't? So at a market level, it tries to understand momentum, but at individual stock level, it does not care at all. It's not even an input for it. So we're not technical investors. We don't understand it and we just stay away from it. So like you said, news, I don't care about news, except unless it's corporate governance news. I don't react to it. Algo doesn't even, and the reason for that is a lot of news is noise. So in the Trump era, right, Trump tweets about aluminium. Is that news or noise? How do you solve that, right? It's non-trivial and frankly, irrelevant. So we just stay away from that because we say if you've bought good companies, you can buy, hold and forget about it, no problem.
Kanika, you've chosen possibly the most difficult path for yourself, right? And especially in an economy like India, right? And I think, what we've possibly seen in the last, 2.5 years. I mean, you've been in the venture capital ecosystem as well, right? What we've seen in the last 2.5 years has been absolutely abnormal, right? I mean, we never anticipated.
No, it's normal. There are cycles. We're in a good part of the cycle.
This is a cycle. So the point that I'm trying to sort of come to, right, is this is, and why do I say it abnormal, right? And I mean it, right? With all seriousness, is that, we never. See, we are a fairly complex economy, right? We are an economy which operates at many levels, right? We still don't have absolute understanding of, for example, consumption that happens at the bottom of the pyramid, right? We have large visible indicators, we have large visible numbers, but we cannot definitely say that this is something which is happening, and that's not something which is even getting captured in the macroeconomic data that is coming out of, say, MEA, Ministry of Finance, so on and so forth, right? You have larger indicators, right? Now, what we've experienced is a very, very different economy, right? We've experienced an economy which is now the arbitrage has gone away, right? Earlier, there used to be a physical arbitrage. So something happening in, say, Bombay would not happen, say, in a Pune in that sequence of time. That would possibly be a lag, right? And that essentially means that the consumption is going to be in a certain format. All of the models that we built, right, were essentially dependent on a lot of that structure, right? And these are not structures that got defined in a decade, right? These are structures that got optimized over like a couple of decades, right?
Like a generation.
Like a generation, right? What we've experienced in the last 2 years is abnormal in the sense that everything is now getting disrupted, right? We're talking about a D2C economy coming up. That essentially means that your players, like, for example,
old playbooks are gone.
Absolutely, they're gone, right? So your HUL, for example, could lose significance, or your Marico could lose significance much faster than what they possibly did, right? And that cyclicity was relevant in that period, right? Cyclicity today has a very different meaning, right? It possibly has a meaning of shift, right? Now,
Yes.
this complexity increases when we talk
Yeah.
of liquidity in the market, right? Now, there are a lot of fintechs that are getting funded, right? This is also an abnormal event of liquidity, right? Now, a lot of course, cleaning up of books is happening,
Yeah.
but money is more easily available. Gig economy again is taken
No,
off,
that's
right?
absolutely,
So
it is abnormal from that. Actually, I was just reading the New York Times. In 2015, there were 90 unicorns. It sounded insane. Now there's over 900.
So listen, I'm not even talking about unicorns, right?
See,
I think it's
yeah,
a misnomer, right? I think
yeah,
a lot of these unicorns, have questionable practices, right? I'm not even getting there. But my,
sure.
my fundamental point is that, from a consumer standpoint, right,
Mm.
we are in the toughest of all phases, right? We really don't know what the future holds, right? A company with certainty cannot say how much are they going to do, right? There are certain, like I said, reflections. Uh, Coming back to my core sort of a question, right? And coming back to what you're possibly doing is money management, right? A lot of these traditional businesses are not necessarily understanding the challenge, right?
Mm.
What they also lack is entrepreneurial spirit to help them tide over this dramatic
Lots of
shift,
them don't.
right?
Yes, yes.
That makes your job very difficult, right? In an environment where
Yes,
you are training your models, right?
yes,
The trends are not necessarily clear, right? What you're possibly banking on is something that has existed in the past.
yes.
It might not necessarily, we
Correct.
might not see a
Very true.
reflection of that, right?
Very
Makes
true.
your job difficult, right? How are
Very
you
true.
balancing all of that? Would love to understand.
Yeah. So twofold. One is what is my mandate, right? My mandate is, can I consistently find a basket of 15 stocks that do
Sure.
a little better than the index and do
Mhm.
it often enough to deliver significant alpha? Okay, that is
Right.
my mandate. Will I miss the next Google?
Sure.
Probably,
Okay.
because it will not have sufficient data for it to even come into my model, right?
Right.
Fresh IPOs, for example, not enough data.
Sure.
They don't make it. Will I mix it? Yes. The point is, there are so many ways to make money on the market. This is the way we've chosen, which is
Right.
pick a basket of good stocks often enough, do it in an unbiased, unemotional way, and that will deliver alpha.
Mhm.
Now, the point you're making on future projections and the point is that the markets are so dynamic, things change so much.
Mhm.
Again, twofold to that. One is the models we built are not static.
Sure.
The reason quant has gotten such a bad rap is because it works till it doesn't. Right? Models work on some back tests, and then as soon as market conditions change, they break down and nothing works anymore. And this has happened consistently, and that's why we'll say quant nahi, whatever, pata nahi.
Right.
So for us, what we're saying is that this time it is truly different because what has happened in the last 5-10 years also is computing power has exploded, and
Right.
to your point, data has exploded.
Mhm.
All right. So as soon as you have those two together, it's very, very potent for machine learning.
Mhm.
So what we've ended up building is a lot of dynamic systems that adapt to the market.
Mhm.
So it's not like we're saying कि अच्छा ये PE, ये growth, ये cash flow होगा, so we'll buy this company. But now
Right.
what we're saying is that the definition of fundamentally good has also changed a lot. So
Mhm.
what is good in one quarter is not good in another quarter. I can
Interesting.
keep using, so what is a good PE? How does that
Sure.
talk to growth rates? How does that talk to
Right.
debt levels? What does that talk
Mhm.
to cash? We're saying
Right.
that whole relationship is constantly evolving in different
Mhm.
markets. So the point I'm trying to make is that we've built models that are extremely dynamic. There's no
Mhm.
staticity, and they
Sure.
adapt to different market conditions.
Right.
That's one. Two
Mhm.
is, will I miss opportunities? Absolutely. But like
Right.
I said, so many ways to make money on the market. I'm okay to miss. There's distressed things you can do, special situations, IPOs, pick a bunch of good companies, different themes, right? So this is the lane. And if you can do one thing well, do that well. You can't be everything to everyone.
Interesting. That's
Right?
a very important point that you've highlighted, Kanika, right? That
Yeah.
you can solve for some people, not, and you don't necessarily need to solve for everybody out there, right?
Correct.
And I think there's always a set of people who are fairly comfortable with what the market has to offer, given that it's done right, right? They're
Correct.
not, for example, venture capital investors, right, or early stage
Yeah.
angel investors, right, who are
Yeah.
expecting exponential returns, right? That's not really the case. If you're beating the index by a couple of percentage points, that's a fair position and
Correct.
play
So,
to see.
so for our, for the multi-cap product that we have, our target is, can you do 20-25% a year
Sure.
over long periods of time? I'm
Mhm.
doing that, but that's very good for public markets. Nifty does 10%, right?
Very
Can
interesting.
so that's what I'm trying to do. And another point you made, right, on this data, where is it showing up? Markets are way smarter than you think they are. In short term, they're really not smart. Long term, they're super
Sure.
smart.
Right.
So what happens is that your information is showing up somewhere. It's
Right.
showing up in your fundamentals, or it's showing up in your valuations, in your
Right.
market multiples somewhere. Market knows, right? So for example, these recently listed IPOs, these tech IPOs, although they've had a little bit of a beating, they're still trading at premium, right? Because
Right.
markets have decided that that's the future and that's what should be valued.
Kanika, I started my career with, in secondary markets and public markets, right? And
Right.
today I'm in media, right? And trust you me, my perspective has changed, right? The way and the silos that data exists in is unfathomable, right? And I think that's where my concern of inconsistency information comes in, right? Also, there is a lot of market which has been taken away by the newer startups which are not in the public listed space, right?
Do you
And
mean
you really don't
liquidity?
know.
Do you mean
And they're
like
becoming
market
black holes.
share?
No, they're becoming black holes. I'm saying these are consumption patterns, right? These are engagement with consumers, right? So you have some indicators. You don't have a lot of information.
You're right.
I am in a, and not really sort of praising myself, but in a unique position to understand those silos, right?
For sure.
That experience helps us do this.
It's like, for example, I'll give you an example, right? But you're right. Do I have all the information? I definitely don't. It's an 80-20 rule, right? Do I have enough information to make a decision? It's like when you toss a coin, heads or tails is 50-50. Most of it is just you toss and you wait. But there are lots of other factors that determine which side is going to land, right? The force with which you toss that coin, the wind that's blowing, right? The humidity. There's so much. But Mota is 50-50. So for us, what we're trying to say is, can I capture 70 to 80% of the information to make a decision? Am I losing out on? Yes. But the whole point is humans think that they have a lot more information when they're making a decision than they actually do.
They don't. No, you're absolutely right. And I completely agree. And it's a little more serious than, the blowing of the wind and a bunch of other things, right?
But you know what I'm trying to say. It was just.
I do. Kanika, we're going to move a little on the product side of things, right? Now, when I look at all the information that is available about Upside, right? One thing that stands out is that where you very clearly highlight that listen, we're looking at 50 million ideas to build a stock portfolio for you, right? Now they're like, and when you say that essentially means many permutation combinations, something that you alluded to, right? What I would love to understand before I question you on say a bunch of things around it, right? What I would love to understand is, what are the products that you're offering, right? How are you cutting the market, right? You alluded to it, right? That you, for example, say IPO could be a strategy, de-stress could be a strategy, right? You could consider overall macros, and you can then marry silo-based data, which is performance indicators or performance data, and then figure out an opportunity, right? And they could give you trends in the future. So what I would understand is, one, how are you cutting the market, right, in terms of products? Second, what I would understand is, what's the longevity of this, right? Are these ongoing products, or is there a definitive cycle that, say, for example, you have a buy only or long only portfolio, right? For example, Motilal Oswal specializes in that, right? There are a bunch of others who are, essentially in the trend momentum. They're playing momentum, right? Where are you cutting on? I mean, how are you cutting the market? What are the products that are available right now with Upside?
Sure. So twofold. One is we are trying to. My competition is not the algo traders or the HFT guys. My competition is Motilal Oswal. I'm trying to take those dollars. I sit in the fundamental basket. So when a wealth manager is doing asset allocation, I'm sitting in the 99% of money that's going to fundamental guys, not the technicals or the high frequency guys.
Sure.
Right. That's one. Two is the kind of products we have. What we're trying to do is address risk profiles. So and therefore return profiles follow. Right. So we have 3 products at the moment. The one that we launched, the oldest, was our Flexi Cap. It's called Upside Multi Cap, where the entire universe is fair game of equity. It's pure equity. You can buy anything you want as long as it's a liquid stock. Buy it. Right. And because so much of the market is small and mid caps, there are only 100 large caps according to SEBI. Right. Everything else is small and mid caps. So it does end up being a tending more to small and mid cap sort of product.
Okay.
Right. The other one we do again is on the equity side, but focused only on large and mid caps.
Sure.
So we'll buy only in the top 250 stocks by market cap, maybe 10,000 crore plus.
Sure.
And the third product that we've most recently, so the first one, high risk, high reward, right? Target 20-25% returns, churn often, churn every quarter. A top 250 type where you're buying large and mid caps. They're more emerging blue chips. Buy, hold for a year at least. But the alpha is lesser, 15-17% returns is what we think we can do over long periods of time. And of course, none of these are guaranteed returns, right? This is equity markets. I just want to make sure that I'm making that point. And the third one is the Upside Navigator, which we most recently launched. This is built for volatile markets. What we're trying to do is read macros, liquidity, to your point, interest rates, inflation, yields, and try and figure out where you should sit between equity, debt, and gold. Right? And sort of move between these 3 asset classes. And then, the underlyings are very boring: government bonds, gold ETFs, large caps. So idea there is, can you deliver a 12 to 15% type return where you're beating Nifty, but you have no, you're cutting off the extreme ends. There's no minus 50% plunge. There's no plus 100%. It's just, can you sleep well at night knowing that your returns are in a very narrow band?
Interesting. Right.
Right. So this is a product for good sleep.
Right.
is why we've launched it. So that one, we think, 2022 is tailor-made for a product like that, because it
Right.
isn't, I think it's going to be a very volatile period where everything is, liquidity starts to dry up.
Very interesting.
Yeah. So again, so risk defines our products, not so much returns. They sort of.
I will come to you on a risk question, and that's an independent topic in itself, right? But
Sure.
we'll try and cover that right through the course of conversation.
Yeah.
Risk is important, right? When you are into asset management, I think defining risk becomes important, right? Kanika, what I understand, right, is the stock picking process, right? Now, see, I understand, right? When you're saying that, listen, I am targeting, for example, say product A, right? I have 100 stocks that I'm kind of going after, right? What is the size of the portfolio, right? What's the size of the portfolio that you would typically look at, right? Or like I said, right, is this momentum based, saying that, listen, there is a shift which is happening. I need to, how do you resize, for example, right, your allocation? Because, there could be a momentary play in that, right? Does that fundamentally make you a very, action oriented, management process? Would love to understand that.
Yeah, so let me talk to you about what the investment process is, right? I'll answer some of your questions. So what we do right at the beginning is pull P&L balance sheet cash flow for the entire NSE universe. There are 2,500 stocks, everything gets pulled, right? When you start cutting off, you cut off on all the liquidity, so all the kachra goes out, right? So one is a set of liquid stocks. We don't look at PSUs within our universe, mainly because, there is a lot of wealth maximization for one shareholder, which is the government, right? Not so much for minority guys. And IPOs, because they don't have enough data. So these are the three things that we cut out. Everything else moves on to step 2, where each company is now converted into a bunch of ratios and numbers that any good analyst would look at to buy a stock.
Right.
Growth numbers, return ratios, debt, cash flow, valuations, regular fundamental stuff. Right. There is no, like I said, after this point, Algo does not know volume of anything. Algo does not know price movement for anything, right? It's just looking at fundamentals.
Right.
So now every company, now think of it as a massive grid where each company is represented by about 20, 30 numbers.
Sure.
Okay. Step 3 is the 50 million point that you made, which is now the algo is trying to teach itself.
Right.
What it's doing is it's a hypothesis-based sort of self-guided search where it'll start at some point, 3 months, 6 months, 1 year back and say, okay, what if I pick companies with these kind of fundamental profiles? How would they do?
Right.
That portfolio can do anything. It can do well, poorly, something. It'll learn something and say, okay, I think I need to tweak my fundamentals or my process a certain way, go back and pick another portfolio. That's what we mean by 50 million portfolios. There are actually 50 million ideas it's looking at, where each idea feeds into the other one, where it's trying to teach itself the definition of fundamentally good to do. Right. So it's saying, let me go back in time, look at, and that's what we mean by there's no one fixed growth number. There's no screener I've built to say 15% growth, 15 P, 15 ROE, I'll get a bunch of stocks, do some quantitative work and buy it. This is basic hygiene everyone should do. Right. We're saying we are now 2.0 of that, which is why is this 15 number, this magic number we've come up with. Right? That number keeps changing. And that number changes based on what the debt on books was, just as an example. So that's really what it's teaching itself in, step 3. And at the end of this 50 million ideas, it's telling you, okay, I think I now understand that what are the different pockets of market, how fundamentals are talking to valuations to price. Here's a list of 15 stocks that you should be buying. Here's the weightages in which you should buy it.
Interesting.
Then we do corporate governance work. This is not, it's not automated buying, selling, nothing. There is a human involvement, and that is really to make sure that there is no garbage in, garbage out, right? Has Yes Bank been thrown up last year, right? So for example, that's the kind of stuff we make sure that, and why am I doing that? Why is there any human intervention? Human intervention is because everything is built on data. If you cannot trust the data that went in, you cannot trust the output. So that's the only reason we get involved, to make sure that everything that went in was appropriate. And then you buy that portfolio, you buy, hold, forget about it, come back, revisit it periodically. Multi-cap we revisit every quarter, 250 we revisit every year. And that's it. And so it's a buy, hold.
Interesting. A difficult job at hand, and I think just too much of a pressure on the algos that you've possibly, or models that you've built.
Yeah, and then we just do that, then we relax all day, then come back at the end of the 3 months and then do it again. So,
I am 100% sure it's easier said than done. And it seems fairly complicated, right? Because when you're playing with a piece of technology, you always, my sense is, I think it just makes you, especially when it's money management, right? I think it just makes you, just makes you uncomfortable at a different level, right? At a higher level. Because you constantly want to go back and check and recheck and so on and so forth, right? And I think there are certain movements, it's a different ecosystem, right? Let's agree on that one.
Absolutely. And sometimes you're buying things and you're like, yeah, of course, I'm buying now mid of March 2020. Model has said, okay, now we're buying all this. For me as a human, I am, and at that point we had some 3 crores AUM. That's
Right.
it, right? I am, pardon my French. Actually, I shouldn't, but I am really not sure I should be buying anything, right? But now we said no, we are unbiased, unemotional. Model said we're buying it, so we bought it.
Kanika, that's a bold call in a market which is, just so insignificant when it comes to equity participation, right? I think
we're
that's a
so
difficult
new,
and a
right?
tough call.
For us, the product was 3 quarters old when this was happening on 3 crores of AUM. And, if it was not working out, that's it, right? We're done. No one's giving you many chances to try this. But
Oh no, absolutely not. I've been on that side of the game, right? And I think one thing I've continued to fear is that if you lose somebody's capital, right, that capital is not going to come in for a very long time, right? And I think that is not really what you want, right? I think fund managers are not necessarily very sensitive to this fact, right? I think the sensitivity is important that their actions could have a very long-term repercussion, and I think loss of value and more importantly trust, right? That's
absolutely.
And in an economy as new as India is, I think you really need that trust.
And for us, the middle class kids, right? Our ticket size are 50 lakhs. For me, that's a lot of money. So when someone is giving me 50 lakhs to manage, I'm actually worried about making sure that we deliver for them. So it's not my control, which is, I guess, a good thing and bad thing, because a lot of it, we're trying to make sure machines make good decisions. But that is my sleepless nights, which is making sure that I'm doing, one is my fiduciary duty to my investors, and 2 is making sure long term I'm actually making money for them.
Interesting. Kanika, what I would love to understand, I mean, you of course give me the process, which is amazing, right? What I want to understand is, you kind of alluded to it, right? That 50 lakhs is, what you, for example, say pick up. Now, I want to understand the structure of it, right? Is that your minimum? Are you structured as a PMS? What's happening on that front, or is this more structured as a mutual fund, ongoing, or is this assistive, right? Where people have their, for example, existing, accounts of stock trading, right? And then this gets plugged in as a layer which manages your money, right? Where are you? How do you position yourself?
Right. So we are a PMS. We operate, under a PMS license from SEBI. Our minimum ticket sizes are 50 lakhs. And that is why, so the market ends up being about, 2-3 lakh customers. That's what we've been focused on at the moment. We are end of this month, next month, launching something for lower ticket sizes where we want to start targeting the next set. Right, this is 50 lakh plus. The next one is the 5 lakh plus tickets. So that will be the next set that we end up doing. Launching slightly different products, but very similar underlying technology and approach. Of course, the 2 are very different in the products we'll build for them, but the approach will be the same, which is, we believe machines will do a better job than humans over long periods of time to invest for you. We will do only fundamental based investing. We will not constantly trade for you. And so here's what we're going to offer. So excited about it, but that will come in maybe next month or so.
Interesting. Kanika, on the point of machines managing, right? I actually want to sort of talk to you about distribution, right? But before I talk to you about distribution, one of the pieces that I want to understand, right, is when you are, see, PMSs, are done for a certain reason, right? Are done for a certain set of clients, right? Now, a lot of those clients are essentially people who want to preserve their wealth, right? And that's the fundamental, right? There are many debt alternatives, for example, that have come up, right? But I think one thing which is constant, right, across, say, newer world asset managers that have come up, the older world asset managers that are there, older world models essentially factored this in, right? Where they had a certain, there was a relationship management structure, right? You had somebody who was savvy enough to understand the markets, understood the trends, was there to assist investors in taking a call, right? And then post-investment would manage that relationship, keep them posted, updated, so on and so forth, right? Now, what you're possibly building is a very clinical system, right? You're saying that, listen, I have created this this model. Data gets it's data in, data out, right? Data in, transactional information, and that gives us transactional information, right?
Yes.
India is still a market which needs handholding when it comes to money management, right? You still need that assurance that, listen, we are in control, right? And that's the requirement of that is very physical. And when I say physical today, I essentially mean over Zoom or something, which is very personalized, right? I know this person. I know Kanika is managing my money. I have trust in her. That trust relationship is very important. And that's the reason banks, for example, have done a phenomenal job. Or IFAs, certain credible IFAs have had a phenomenal run, right? Because they were out there to sort of do. How are you taking care of that, right? Because that's very, very important in money management.
Yeah. So twofold. One is, let's split it up. There's wealth management, and then there is manufacturing. Wealth management, your wealth manager is your therapist, right? that's a very, very tough thing to get away from. When markets are falling, you need to call someone and say, "Main kya karu?" It's very, very important. So I think that will be the last leg of fintech that will get disrupted, which is your actual human touch to, for at least for HNIs to call up and say, world is ending, what do I do? Right. On the manufacturing side, currently that is the system, right? There are these webinars and someone will say, oh, I bought this one stock and this was our great thesis behind it and this is why we did it. We don't do that. When clients tell us, do you have webinars? I said, what will I come on the webinar and say? What will I tell you? Right. So we don't do that. And so why will someone add us to their portfolio? Right. The reason they add us to their portfolio is again diversification. We're the first PMS for lots of guys who are under 35 who understand that technology will do a better job than humans. Right. But that's a much smaller segment of the PMS world. Most of them are 40 plus. For them, we probably be the third or fourth PMS that comes into their portfolio. And the reason we're added is diversity of approach. How many growth at reasonable price PMSs will you buy? Right. What we're saying is add us to get a diversification away from humans, human biases, human approaches, do something different. And because the portfolios we build look very different from what humans end up buying. There's a lot more overlap there than there is for us. So the main reason people add us is because we are unbiased, unemotional, and completely different from anything else they want. It's like why you buy a large cap fund, a mid cap fund, a small cap fund, right? Diversity. Same thing, this is diversity of approach.
Interesting. Kanika, that automatically brings me to our next question, right? Which is that on distribution. How are you distributing your fund, right? I mean, are you picking up a traditional path where you are kind of partnering with wealth management companies? And there are quite a few of the larger ones that are out there, right? Are you piggybacking them to get to the customers, or are you like in a D2C environment, right? Kind of building a new channel, right? That is a direct communication where you are talking to, say, slightly more mature audience, right, who understands stock markets, and you're building a direct relationship, saying that, listen, this is who we are, this is what we do, this is the product, which also means that you're not essentially calibrated for a mass market play for now, which eases the pressure on creating a much larger jing bang in terms of people, resources, infrastructure, right, which is required for a business like this, right? Which is the path that you're taking? I'd love to understand that.
So, this surprised us also, but we're small right now, right? We're about 100 crores in AUM. It's split. Half of it is direct, where people just read something about us, came to us and say, this is the approach that makes sense to me, so I'll give you money, right? So a lot of that is, but I don't think on the 50 lakh tickets that is particularly scalable. So we're doing two things. One is, of course, all of our onboarding is going digital by next week, where a PMS customer can literally come online to our website and sign up. But I don't expect that to be how people do it, right? Like you said, wealth managers are your therapists. That is the way to grow. We are tied up with a lot of distributors who in turn sell it to their clients. So that is the main engine of growth for us on the PMS side. On retail products, etc., like you said, D2C brand, that is, it's for us still, beta, figuring out what's the right approach. Is it working with the IFAs? Mutual fund revenues are drying up for them. This is the next avenue of growth. Is that the direction which we'll go? So there'll be 2-3 things we do there. I don't have the answer yet, but I think it'll again end up being a mix of direct and indirect. But currently, we're split direct and indirect, but ask me next year, I'm hoping to be 80% indirect and only 20% direct.
Interesting, Kanika. Interesting. And I think that evangelization is very important, right? I think especially in a market like India. Kanika, how are you, for example, charges, right? Are you structured exactly like a PMS that is out there?
Yes.
Or is there a different way you kind of, the middle business model is built on a slightly different structure, right?
No, it's the same way. We're built the same way, and it is by design. I'm not going to be, no one is, when someone is giving us money, it's like, chalo, try karte hain, but it's still serious money management that we're doing for you, right? So our structures look very similar to the rest of the market on the PMS side. The only difference is I have a lot more scope as we scale on my cost side to be able to compress that, but there is no reason to do. Why will I, this is, we're all in the business of making money, right? So as long as I'm doing...
And what's the construct there, right? I mean, how much are you charging on a fee, on the management fee side of things, and how much is, are the carries that you, profit sharing carries that you get?
Yeah. So we have, 2 or 3 fee structures we offer. There are always blends of fixed fee and profit share. But clients can come to us and say, hey, I don't want to pay you any fixed fee. I'll only pay you profit share. We're very happy to do that. In fact, we prefer it because I believe in my product. I think I'll make more money. Right? Think about it. We've got clients who came to us in March 2020. on only profit share structures, right?
Sure.
So everyone laughed
But
all the way to the bank on that.
doesn't that sort of dampen your aspiration to sort of go out and partner with many of these distributors, right? Because they've been kind of designed to enjoy the
Yes.
fruits immediately, right?
Yeah.
You know what I mean,
So
right?
we give them all options. We say
Right.
here are these 3 fee options you can do. It's a mix of fixed and carry. Do whatever works best for you and for your client. We're happy to go with that. Mota at 20-25%, they end up at the same, roughly 2% of AUM as fee.
Interesting. Kanika, towards the end of a conversation, right? And how I want these conversations to go on. It's becoming cliched, right? My dialogue is becoming cliched, right? By the end of it. No, but we're towards the end of the conversation, right? Would love to understand what's in it. What is your tier 2 strategy, right? And one, of course, how large are you? You kind of mentioned that, in terms of the assets under management AUM that you have, right? It's about 100 crores right now. But what are the numbers like? How many, for example, unique clients would you have? I know there are certain numbers that could be private, and you might not want to be. You might
Maybe
not be
not
comfortable giving.
anymore. SEBI's done such a good job of
Sure.
making everyone transparent.
Right.
Your number of clients, your AUM, it's there for everyone to see.
Sure.
You go to the SEBI website and your performance, nothing you can't hide anymore, right? And I think that's great. We have about a little over 100 clients that over for who we manage this money. Our average tickets are about 1 crore or so. You can come in with 50. Usually people come in with 50 and then start topping up. But we do believe that we'd like to democratize tech-based asset management. That's really our vision. Over the next 2 years, we don't think that this is all there is to it. We think using technology to invest is the way forward. What you talked about in terms of wealth, etc., is downstream, right? They're going to distribute and doing a great job of distributing digitally. We're saying let's go one level up. Let's start manufacturing using technology, and that's really the problem we're trying to solve for larger India.
What's the tier 2 strategy? Is there a tier 2 strategy right now, or is that something which is going to happen beyond, say, next 15, 18 months, 2 years, right? Because I know, as a matter of fact, I think PMS has largely been concentrated towards tier A series, right? Tier it, but there is the kind of growth that tier 2 series, for example, seen is absolutely phenomenal, right?
Phenomenal.
What's your strategy there? Is there a plan of action there, or are you going to largely depend on the distribution network that you create, right, to go out and source for you?
So twofold. One is, you'll be amazed at how many direct queries we get from, the North, Dehradun, Kanpur. So you've got clients that just reached out and said, "This is a strategy we believe in. Let's do it." Right? It's amazing how quickly things are changing.
Right.
I have less clients from Bangalore than I do from the North. Weird, right? And second is distribution has gone digital faster than any of us could have imagined. Absolutely. Even in Nippon AMC, right? Number 2, number 3 in rankings, 50% of their new transactions are online now.
Right.
Right. That's how quickly everything is moving. For us, we do believe a lot of the shift or strategy around tier 2 will, of course, be indirect channel partners, but a lot of that will come direct, which is why we need to very quickly make sure onboarding on the PMS side and retail side goes digital. It's going to
interesting, and it's possibly not as delayed as one would think, right? This is something which is going to parallelly happen between. While of course you're building a tier A business, right? You're also building a tier 2 and tier 3 business, right?
Yeah, you can't. It's all here. And to your point, I think like we said, right, pandemic is basically hacked growth. It's changed the fabric much quicker than you would have imagined.
Absolutely,
so look at our demat accounts, look at how much has gone online, look at the markets, financialization, how much retail now contributes to market movements.
I think my belief is, Kanika, I think the speed of information has kind of changed that, and I think more importantly, people had time, right? And I think once you have information, and more is available, right? I think that gives you a certain confidence. It takes away the inhibition, and that's possibly which has happened. The good part is liquidity has been there. People are not going out, right? That essentially meant that they were craving and itching to sort of say participate, understand, get a flavor of, and I think that a lot of that is essentially experimental, but the good part is that given the performance that we've seen, right, I think a lot of that will possibly become a very regular consumption pattern, right, which is very good for a lot of asset management businesses, right?
Absolutely. But what's scary is that they've only seen bull markets. I'm worried because when you start in a bull market, you've not learned enough, right? So there'll be some, basically it's not a straight line up. There'll be pitfalls even in terms of.
Does that give you a fun question, right? Does that give you sleepless nights, right? That what happens when we see what we see? Because a lot of this growth has been abnormal, right? And I'm sure you will agree with this. And possibly this is I'm going to reserve this question for our next conversation in a detailed form, but the quick comment is always helpful, right? What we're seeing in the stock markets, right, is unreal, right? The kind of growth that we've seen, it's possibly because of the massive liquidity that's now available in households, right? But the stark reality of it, when you start looking at macro data, right, is that a large percentage of households are essentially eating out of savings, right? Now, when you look at that as a foundational form of data, and when you look at the market movements, right, I think there is a certain disparity, right?
No, there isn't. There isn't, because it's a K-shaped recovery we're seeing. There is what you're talking about in terms of eating into savings, etc., is at a different income level, and above a certain income level, everyone's rich is getting richer. I don't think that there is disparity there. I'm a lot more worried about if the market is understanding risk as well as they're understanding return, which we're going to talk about.
I hope so. I hope so. We're not overlooking a lot of that because of the liquidity that is available. Kanika, we were to cover risk, right, as an element.
I know we've just been chatting.
But I'm going to reserve that, right? Because currently, I think the category that you're catering to, right, is not a category where risk, for example, a few percentage points upward movement, downward movement is not necessarily something which is going to dent their ability to consume, right? I think risk needs to be understood when you're talking about the mass market play, right? And I think in that context, right? And I think overall risk in the markets, I'm going to reserve that for our next conversation, right? And I think that'll possibly be an independent conversation itself, right? Because of the diversity and complexity that we have in the market. My last question in this conversation, Kanika, is that you've been in a unique position, right? You've been an investment banker, you've been on the venture capital side of things, and now you're an entrepreneur, right? So that's that very few people can actually kind of talk about all of that, right? What's one suggestion, advice that you would want to give out? This is again cliche, but I usually use this as the occasion for every journey is unique, right? Everybody has a lesson to share, and everybody has something to learn, right? That's the fundamental thought process that I work with. What is that you would want to give out, right? Like I said, and you're in a unique position. So with a little bit of a condiments of your venture capital investing also will be helpful, given that a lot of startups are going to be watching this.
Right. So I guess there's internal and external advice. Internal, when we started this, if I know what I know today, I would probably not start 3 years ago, right? You have to be a little naive and stupid to think that you can change things, right? So perseverance, is what you need internally. That's one, right? Keep at it. And external or skill building is really read as much as you can. Cliched answer to your very cliched question, but you have to read. Make sure you have an hour or two in a day that you're reading about anything. I'm a big fantasy fiction geek also, right? I just read. You just need to read a bunch of stuff to improve how you think and expand the dimensions of your mind. So those are the two things. Be a little stupid, but be also a little smart. Read a bit.
Kanika, somebody very classically said this to me, right? And it actually stayed with me, right? And then that person said that it requires fool's confidence to win millions, right? And that stayed with me, right? And I think what you kind of say essentially is very close to that, right? That have that naivety, right? Because that possibly helps you think and understand the problems that people who you're going to be speaking with, who could be potential customers, will possibly be experiencing the same problem, right? So I think that naivety and that genuinity to the cause, right, I think helps you solve better. I think just so much more important at a DNA level of an organization and how it gets built, right? Kanika, thank you so much for doing this. It was a absolutely phenomenal conversation, a spectacular conversation.
Loved it.
I usually enjoy all of my conversations on money management, right? But this was something which was different, right? This is something I've had very diverse conversations, right? There are people who are using a lot of tech to improve customer experience, right? There are a lot of people who are using tech to identify, for example, stocks, right? The front ending continues to be that of a human layer, right? When it comes to money management in India, and that's so much more important, right? I think this was a very different conversation because, here technology is literally replacing the inefficiencies and the emotional aspects that humans can bring in, the tendencies that the fund manager can bring in, right? You're clinically cutting it, right? With, of course, challenges of the market. I think as an economy, we're still kind of growing. That liquidity is still getting built up, which is such a critical requirement of an efficient market, right? But like I said, right, I enjoyed this conversation. We wish you all the very best. I think you have a very long and a large path and responsibility to sort of take care of.
For sure.
We
For
wish you
sure.
all the very best. Thank you for doing this.
Thank you. Thanks for having a chat with us. Really enjoyed it. Take care.
Thank you.
Bye.